Today, the Bank of England lifts rates again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the Bank of England lifted rates, in fact, for the 12th time. And this, of course, is going to put more pressure on households in the UK. At its meeting on the 10th of May, the MPC, that's the Monetary Policy Committee, voted by a majority of 7-2 to increase the bank rate by 0.25 percentage points to 4.5%. Two members preferred to maintain the bank rate at the 4.25%.
So the outlook for growth and unemployment has improved. 6 months ago, we were expecting a shallow but long recession. Since then, energy prices have fallen substantially, and economic activity is holding up better than expected. So today, we are forecasting modest but positive growth and a much smaller increase in unemployment. We think inflation will fall quite sharply over the coming months, beginning with the April number, which will be released in 2 weeks' time. Energy prices have fallen from their peaks, and that will now start to come through as lower inflation. Food price inflation should ease too, though we can be less sure about this on timing. But let me be clear, inflation remains too high, and it's our job to get it all the way down to the 2% target and have it stay there. And this is why today we've increased bank rate by 0.25 percentage points to 4.5%. Low and stable inflation is the foundation of a healthy economy, and we have to stay the course to make sure inflation falls all the way back to the 2% target. In the Monetary Policy Report we present today, we've revised up our projections for growth in the UK economy. In the central projection shown in chart 1 here, the UK economy grows at a moderate pace over the next 3 years, with calendar year growth expected to be 0.25% this year and 0.75% in 2024 and 2025. Now, this is not a strong forecast, and we still expect a degree of economic slack to emerge from the end of this year. But the growth outlook is less weak than in the MPC's recent projections. Recent survey evidence supports this upward revision. Consumer confidence, though still weak, is at its highest level for over a year. In the March edition of the bank's NMG survey, households were more optimistic about the general economic situation than in the previous survey done last September. And the bank's network of agents has reported that activity has been stronger recently than their contacts had previously expected. Now, above all, the improvement in the outlook reflects a further fall in wholesale gas prices, reversing some of the terms of trade shock that has been the primary cause of falling real incomes. But there has also been greater resilience in the economy than we'd expected, as seen, for example, in strong employment numbers. Fiscal policy is also expected to boost GDP over the forecast, building to a peak impact of around 0.5%. Both the temporary 100% capital allowances for qualifying business investment and measures aimed at increasing labour market participation are assumed to have positive effects on potential supply. So let me turn to the outlook for inflation. Annual consumer price inflation has come down from a peak of 11.1% in October last year, but it remains very high. The latest figure of 10.1% for March was 0.8 percentage points higher than we had expected at the time of the February report. Higher food and clothing prices account for most of that upside surprise. Food inflation has been particularly high, reaching 19.1%. And as you can see in chart 2, this is not just happening here in the UK. Food inflation rates are similar across Europe. We are acutely aware of how difficult this rise in food prices is for people, and especially for those people on lower incomes. We do see that food price inflation will start to slow. Global prices of wholesale agricultural commodities have come down since the spring of last year, and food producer price indices have eased in recent months. Evidence collected by the bank's agents suggests that food producers expect food production costs to moderate. While this may take longer than we previously thought, we should expect this to feed through to consumer food inflation over the coming year. And I would add that this is what I hear when I visit and meet with both food producers and retailers. And we have good reasons to expect headline inflation to fall sharply from April, as last year's large energy price rises now start to drop out of the annual calculations. In the March release, the prices of electricity, gas and other fuels were more than 85% higher than a year ago, contributing more than 3 percentage points to headline inflation. That contribution is likely to drop significantly to about 1 percentage point in April's data as large increases in energy prices from a year ago drop out of the annual calculations. Looking ahead to the end of the year, the contribution from energy will fall further. This is illustrated in chart 3, which has the level of the typical household energy bill on the left and the direct contribution of energy to inflation on the right. In the fourth quarter of this year, if energy prices evolve as financial market prices now suggest, we can expect the typical household energy bill to fall to around £2,100. Now, let me be clear, that's still a high number, but it is about 16% lower than the level a year before that, when the government's energy price guarantee was put in place, the year before then. Since energy makes up around 5% of the consumer price index, that fall in the prices of electricity and gas, along with other fuels, translates into a contribution to overall inflation from energy of minus 1 percentage point towards the end of the year, which is indicated in the right-hand chart. And it's not least for this reason that consumer price inflation is on course to halve by the end of this year, though to be very clear, our target is a sustainable return of inflation to 2%. That's what we focus on. So we also have to look carefully at other components of the consumer price index. So-called core inflation, which excludes energy and food prices, is driven by items that can have more persistent inflationary dynamics. The upside news in inflation since February has predominantly been to headline inflation rather than core, but we still need to watch out for an effect on persistence. As you can see in chart 4, core inflation is also elevated. Some of this strength in core inflation reflects the indirect effects of higher energy prices. But it also reflects second-round effects as the external shocks we have seen interact with the state of the domestic economy. And as headline inflation falls, these second-round effects are unlikely to go away as quickly as they appeared. The MPC judges that there is an important asymmetry in inflationary dynamics in this respect. And this is why, even as headline inflation is coming down, the MPC is paying particular attention to indicators of inflation persistence, including labour market tightness and wage growth and services inflation. Now, since the February report, the news on these indicators has been mixed. There are some signs that the labour market is loosening a little, though at a slower pace than we expected in February, and it nevertheless remains tight. Employment growth has been partially met by an increase in labour market participation, especially amongst younger people. The number of vacancies has come down from the very high levels as well. As chart 5 shows, the ratio of vacancies to unemployment, which is a key measure of labour market tightness, has fallen as a result. Similarly, job-to-job flows have declined a little in the most recent data. In line with the data, businesses across the United Kingdom tell our network of agents that recruitment difficulties have eased in recent months. Employees are moving jobs less frequently, and employers are getting more applications for job vacancies. Nominal pay growth is shown in chart 6, and that has also fallen back slightly, in line with our February projections. Near-term indicators such as HMRC payroll data and the KPMG REC salaries index suggest that pay growth could ease further later this year. And we hear the same thing from our network of agents. Meanwhile, services price inflation, in chart 7, remains elevated, broadly as expected in the February report. This may reflect some rebuilding of margins as well as wage growth and the indirect effects of higher energy and other input costs. The extent to which firms have already passed through higher costs will influence the pace at which services inflation declines. So, while CPI inflation is expected to fall quite sharply as energy costs begin to ease, albeit at a somewhat slower pace than projected in February given the near-term outlook for food prices, the outlook for inflation further out is more uncertain and depends on the extent of persistence in wage and price setting. As shown in Chart 8, in the MPC's baseline modal projection, which is conditional on a market-implied path for bank rate that peaks at 4.75% in the fourth quarter of the year, an increasing degree of economic slack, combined with declining external pressures, lead inflation to fall materially below the 2% target in the medium term. But the committee continues to judge that the risks to inflation are skewed significantly to the upside, primarily reflecting the possibility of more persistence in domestic wage and price setting. We think the unwinding of second-round effects may take longer than it did for them to emerge. The current circumstances are so unusual, however, that it is hard to be precise about the extent of this asymmetry. So we've not made it part of our baseline modal projection. Nevertheless, the MPC judges that relative to the baseline projection of significant declines in inflation to levels below target, there remains material upside risks over the medium term. Reflecting those risks, conditional on the market-implied path for bank rate, the MPC's mean forecast path for inflation is at or just below the 2% target at years 2 and 3. I want to emphasise the point that having this large upside risk on inflation does not call into question meeting the inflation target in our projection using market rates. Now, upside risks may not materialise, and so the MPC's baseline modal forecast remains for inflation to fall below the target in the medium term, conditional on the market path for bank rate. Let me turn to the transmission of monetary policy. Monetary policy is now working to bring inflation down. Changes in bank rates seem to have passed through, as would be expected, into new mortgage and corporate borrowing rates. Overseas bank failures have resulted in asset price volatility since the February report, and spreads on UK banks' wholesale funding rose. But this was short-lived, implying little impact on the interest rates facing households and companies. While pass-through into household sight deposit rates has been muted, rates on term deposits and fixed-rate bonds have risen more in line with changes in reference rates. These changes are still working their way through the economy. For example, while we have seen higher rates being quoted on new mortgages, illustrated here, by rates on the new 2-year 75% loan-to-value mortgages, that's the blue line, as well as the effective rates on new mortgages more generally, which is the orange to red line, the effective rates on the whole existing stock of mortgages, which is the purple line, are still catching up. Given such lags in the transmission of monetary policy, the rise in bank rates since December 2021 will weigh more on the economy in the coming quarters, and the MPC factors this into its policy decisions. The bottom line here is that over this period of time, the mortgage market has changed to being a more fixed-rate market. So let me conclude with the monetary policy decision today. At this meeting, the committee has voted to increase bank rate by 0.25 percentage points to 4.5%. In doing so, the MPC is continuing to address the risk of more persistent strength in domestic price and wage setting, as represented by the upward skew in the projected distribution for CPI inflation. The pace at which inflationary pressures ease will depend on the evolution of the economy, including the impact of the significant increases in bank rates so far. Uncertainties around the global financial and economic outlook also remain elevated. The MPC will continue to monitor closely indications of persistent inflationary pressures, including the tightness of labour market conditions, the behaviour of wage growth and services price inflation. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required.
The committee's updated projections for activity and inflation actually were included in the accompanying May monetary policy report, and they're conditioned on a market-implied path of bank rate that peaks at 4.75% in 2023 in the fourth quarter, before ending the forecast period at just over 3.5%. In fact, there has been some upside news in the near-term outlook for global activity, with the UK world GDP now expected to grow at a moderate pace through the forecast period, but risks remain, absent of a further shock, and there is likely to be only a small impact on GDP from the tightening of credit conditions related to global banking sector developments. They said headline inflation has been falling in the US and the euro area, although core inflation measures remain elevated. And in the accompanying question and answer session, there was an interesting discussion about why it is that rates of inflation in the UK seem so stubbornly high relative to other areas.
Thank you, Governor, for your presentation. We see now that inflation in the US is 4.9% in April, 7% in the Eurozone in April. Just putting this in international context, why do you think it is that UK inflation, 10.1% still in March, as you now well know, has not only been higher than across much of the advanced industrialized world, but also far from transitory, has actually been particularly stubborn?
Can I make one point? I think Ben wants to come in with another point. Can I make it's a rather sort of mechanical point, but I think it's important to make at this point, because you're right to point out, Liam, why has inflation not come down, faster in this country? There is a particular point about energy prices and the energy price setting mechanism in this country. Actually, it has quite a lot to do with the fact that if you go back, we go back a year now, actually, before the arrangements were changed, the Ofgem price setting mechanism was set only every 6 months. That's important. The reason I say that is because that's why we have a very big base effect coming in for the number that's going to be the April number that's going to be released in 2 months, and why actually those base effects have come through rather faster in continental Europe, or some. I mean, economy was a bit of a mixture, obviously, but I just want to emphasise that's an important point in the current comparison. There was a bit of a flip side to that actually a year or so ago, but that's a very important point in the current point of comparison. And I think
that is actually the vast majority of that difference with Europe is that. So if you look at core inflation rates in March, we are higher than Europe, 6.2 versus 5.7. But the vast bulk of that, what is actually overall a 3.2 percentage point gap, is this point about energy. So coupled with, if you include petrol prices or overall energy, domestic energy and petrol, it's still 40% higher in the UK. It was in March, 40% higher than the year earlier. In Europe, the number's negative. In the United States, it's minus 10%, that inflation rate for energy. And a lot of that has to do with the way that the Ofgem cap is set. It's much more lagged, therefore, the effect. So the effect of these rises is still here for us. I mean, it will come down, but it will come down quite predictably, because we can see exactly what's going to happen to the cap. We know what happened a year earlier, but it will take a little longer. So this is probably the maximum gap. But that is the vast bulk of the difference, is this difference in energy prices. So with the US, by the way, the difference is not just timing, but as you know, they never saw the same rise in wholesale gas prices to begin with.
They said that the UK GDP is expected to be flat over the first half of this year, although underlying output, excluding the estimated impact of strikes and an extra bank holiday, is projected to grow modestly. Economic activity has been less weak than expected in February, and the committee now judges that the path of demand is likely to be materially stronger than expected in the February report, albeit still subdued by historical standards. The improved outlook reflects stronger global growth, lower energy prices, the fiscal support in the spring budget, and the possibility that the tight labour market leads to lower precautionary savings by households. Although there are indications that the labour market has started to loosen, it is still expected to remain tighter than in the February report in the near term, and the unemployment rate is now projected to remain below 4% until the end of 2024, before rising over the second half of the forecast period to around 4.5%, which of course will still be quite low by historical standards. The CPI inflation was 10.2% in the first quarter 2023, higher than expected at the time of the February and March MPC meetings, with the upside surprise concentrated on core goods and food prices. Although still elevated, nominal private wage growth and services CPI inflation have been close to expectations. But they say the CPI inflation is expected to fall sharply from April, in part as large rises in the price level 1 year ago drop out of the annual comparison. In addition, the extension to the spring budget for the energy price guarantee and declines in wholesale energy prices will both contribute to the lower momentum ahead, specifically relating to household energy bills and to CPI inflation. The committee continues to judge that the risks around the inflation forecast are skewed significantly to the upside, they said, reflecting the possibility that the second round effects of external cost shocks on inflation in wages and domestic prices may take longer to unwind than they did to emerge. The mean CPI inflation profile, which incorporates this risk, is at or just below the 2% target, but only in the medium term. Now, there's a few interesting observations and a couple of very interesting questions in the press conference, which I'm going to play now because, well, there was a discussion about the impact on households, a discussion about whether the markets were actually taking the forecasts from the Bank of England and how they were using them, and a couple of other very important points too.
Of the Guardian. Interest rates have now gone up 12 times in a row. Inflation, as you say, is still too high, above 10%. By any stretch of the imagination, that seems to me to be a policy failure somewhere along the line. Now, rather than blaming Vladimir Putin for this or wage bargainers trying to negotiate pay rises for their workers, isn't it time for the bank to own up to its part in this policy failure and say, sorry to the householders who are going to be paying more for their mortgages, sorry to the small businesses who are facing much higher overdrafts. Isn't it time for the bank to say, sorry, we messed up?
Well, Larry, we don't use the language of blame. I really must be clear on this. I mean, I do read, articles which, are cast in those terms, and I don't use the language of blame. What I do think we have to do is set out the underlying shocks that are going on in the world economy and the UK economy that in a sense can cause this situation. And we do push back. Ben made a speech on it a couple of weeks ago on some of the arguments which says the underlying cause is not to do with these other things, it's to do with the way in which monetary policy has been set in the past. But I want to distinguish two things here, so that's the first point I'll make. I think it's important to set out the causes, but not in the language of blame. We're not using the language of blame. If you want to argue that the war in Ukraine has not caused inflation, I think we'd be happy to have that debate with you, but we don't agree with you, I'm afraid. Now, the second, I think, approach to this question is in some ways, I think, more important, which is, okay, yeah, let's take those sort of causes and then say, did you as the Bank of England respond either quickly enough or forcefully enough to those causes? Could you have anticipated those causes and therefore offset the experience? Now, I think that's a debate that we've had for some time, and I think happy to have it again, as it were. I would make the point that as I've made many times before, that there is a level of if you don't mind me saying so, hindsight in many of these judgments. The other thing I would say, as I think Ben has set out, and certainly Silvana Tenera has set out in speeches they've made in the past, that if you take Ukraine as a good case, you have to make two assumptions. One is that we could have foreseen the war far enough in advance to have actually taken action to offset it. So that's I don't get beyond that point, but I'll set the second one out just for the sake of argument, if you don't mind. And then that you would have taken massive offsetting action in the middle of the COVID recession to offset it. Now, we could debate that second point, but actually, I'm afraid I don't even get to that point, because the idea that we could have foreseen the Ukraine war, 18 months or 2 years before it happened, I'm afraid that's a stretch beyond to which I wouldn't go. But that's not the language of blame, Larry. I don't want to use that language. I think we should have a debate about how does policy respond. But I think it is important that we set out the underlying causes here.
Chris? David?
Thank you. Chris Giles from the Financial Times. I'm not going to use the language of blame nor the language of hindsight, just the evaluation. The MPC says there's pretty much a 50-50 chance that inflation will be above its target all the way to 2026. That would be 5 years of above target inflation, 50-50 chance. Is that good performance? How would you evaluate the performance? Is that something you would be proud of?
Well, as you can see from the way we've set the presentation out, of course, that's, we always present the fan chart, so you can always do that. Both on the mean case, so let's stick with the mean case for the moment, which is the one that, where we've put more persistence in than the model would suggest, and that really goes to what Ben was just saying about asymmetry. It brings inflation back to target sort of towards the end of next year. Now, of course, there's a debate about how quickly we should bring inflation back to target and how appropriate are various different settings. And we have to balance that out because we've also got language in our objectives about trade-offs, and we will go on considering very carefully as we meet what is the right path to bring inflation down on. But I think this path that we've got is not unreasonable given the scale of the shock that we've had. I mean, we have to bear in mind the very large scale of the shock that we've had. And I think we have to sort of consider, yes, you could consider paths that would be faster because, after all, bear in mind, you've quoted one side of the fan chart, you can quote the other side as well. But I think that's, what we have is, I think, an appropriate path. And I'll just go back to the point I made to Phil's question, which is we will obviously be driven by the evidence at each meeting and consider appropriately. But there is no bias at the moment in our setting of rates looking forwards. Dave?
And just to use the framing you use, Chris, around, I think any evaluation would have to take account of the fact that we and the global economy has been hit by two, once-in-a-century shocks in quick succession. Again, not using the language of blame, just recognizing the world that we and other central banks find ourselves in. So we have a pandemic, then we have a major pandemic, certainly once in a century, first major war in Europe since the Second World War. And these have had very significant impacts on prices and on price setting. And if you look back at the track record, we started putting up rates in December 2021 when Omicron was, we were still trying to make sense of the Omicron variant. When I say we, I mean the country collectively. I remember there was quite a lot of surprise at that time that we had put up rates against that health backdrop. And then, as I've described, the shocks we've had from the terrible war in Ukraine since then, which are still playing out, and they're playing out in different ways for different sectors. So we've discussed a lot today, rightly, what's happened to food prices, but also, that originates with the war in Ukraine in terms of the shocks from that, but also there are other shocks that have hit food prices, and we as monetary policy makers have to deal with that world. And I think an evaluation of us and of other central banks, because it is the case that we started to tighten policy before other central banks, particularly before the Fed and the ECB, has to take account of the situation that we found ourselves in over this period, which has just been an extraordinary period for the world economy, for the UK economy, and for monetary policy.
I think Ben wants to make a comment.
We've got these ribbon charts which show these probabilities. Their probability of being below. No, but you said it's not. It's not late 26, Chris. It's, I think someone told me the first and second quarter of 25, just to be clear, and it's below 2% throughout afterwards. No, of course not.
No, it's not.
Of course not. That's not what I said. I just wanted to be accurate about the premise of the question.
The point, Chris, I think we're all making is the debate we're very happy to have is what is the the best way to refer to go back to price stability given the shocks we've had. Dave made the point very well. These are two huge events in history.
David was next.
Sort of David Millikan from Reuters. I know sort of in the monetary policy report it talks a little bit about sort of the lagged effect of sort of past tightening. And obviously sort of this is difficult to sort of judge. Sort of things have changed sort of quite a lot sort of since the Bank of England's last tightening cycle. I was wondering sort of how confident can you be that you're not sort of in the process of over-tightening? Because obviously we've got sort of two members of the Monetary Policy Committee who for a number of months have sort of voted against sort of rate rises. So how sure can you be that you're not sort of overshooting here?
Well, it's a very good question because during this round we have spent, I think appropriately, a lot of time on what we call the transmission mechanism and how it's changed. Now, I showed the chart of the mortgage market very deliberately because that is probably the most interesting, I think, area of the transmission mechanism for the reason that it has changed so much over time. Here we now have in the UK a predominantly fixed rate mortgage market. Not fixed rate in the way the US has, obviously, but it's still a fixed rate over a period of time. I think around about 85% of the stock of mortgages in this country is now fixed rate, whereas if you go back, I deliberately showed the long run version of that chart to take it back to a point when that was not the case. And as that chart showed, I mean, we've still got quite a lot of pass-through to come in that world, more so than we would have had in the past at this point in time. And so, yes, I mean, two things. That is a very lively subject of debate in the committee. However, we factor in what we think is the pass-through now. So it's all factored into our assessment. But yeah, of course, there's still, because we haven't seen this sort of thing happen before, we haven't had a tightening cycle with this mortgage market. There is a lot of debate around that, and I'm sure there has to be quite a lot of judgment in that debate.
Thanks very much. Derval Jordan from the BBC. I'm just wondering, what do you say to people who are struggling to make ends meet? Do people, as Huw Pill suggests, need to accept that they're poorer?
I am very, very, and we are very conscious that this inflation, all inflation is difficult, and particularly for those least well off. This inflation is particularly difficult for those least well off because it is concentrated, as we've discussed today, in what are called the essentials of life, food and energy. And the people on lower incomes have a larger proportion of their consumption is the essentials of life, food and energy being obviously the largest elements. I'm very, very conscious of that point. We face the difficult situation that as Ben has said, there has been a very substantial hit to national income caused by these external shocks, which takes national real income, which takes the form of higher inflation. That is passing through, and we have to deal with that. Now, you mentioned what Huw said. Let me be very clear on this. The economics of the hit to national income are clear. But I think I want it to be very clear that we are very sensitive to the position of people particularly all people, but particularly people on lower incomes. I don't think Hugh's choice of words was the right one in that sense, I have to be honest. And I think he would agree with me. But what I'm afraid we can't duck is this very big hit to national income, which we have to deal with, and we have to deal with it. And of course, as we've said a lot, we have to deal with the risk that leads to second-round domestic inflation effects. Ben?
I just wanted to say in that respect something that's, I think, important to emphasise, which is that because, as I said earlier, some of these global prices, many of them, have stopped rising, and indeed some, those related to the pandemic shortages, for example, but most obviously energy prices have actually been falling. There is some relief here, and you can see it in this forecast. I don't want to overemphasize this because the levels of these prices are still much higher than they were before, and will remain so in this forecast. But in terms of the growth rates, there is a little relief. So if you look at real labour income, for example, in this forecast, in the year to the fourth quarter of this year, so through the course of 2023, that is now projected to grow, and to grow quite a bit by over 2.5%. Which would actually be the best annual growth rate we've had for about 5 years. Now, in the long run, that growth rate depends on improvements in productivity and so forth. And it's not the case these prices will fall forever. But that fall is beginning to provide a little relief, and we are beginning to see real income growth through the course of this year.
Hi there, Jack Bonnet from City AM. I just want to go back to the transmission mechanism that you touched on there, and there's obviously a bit in the report today saying that it's kind of been blunted, the way it transmits through the mortgage market, because we've now got a new shape of mortgage market. If you coincide that with the inflation forecast, you're saying quite a lot of the drop is being driven by supply side measures, so energy prices falling, food prices falling as well. Is there a question amongst the MPC now that the actual effectiveness of monetary policy in taming inflation, how effective is it, and has it been blunted as a result of a change in some of the economic structure in the UK?
Well, I don't think Dave wants to come in. I wouldn't use the word blunted. I think we have to adapt our view of the transmission mechanism to the markets that we have around us, as it were, and the mortgage market has changed. And therefore, we have to adapt our view of the transmission of monetary policy, and of course that then feeds back into our decisions. So, rather than blunted, I would say we have to in a sense we have to adapt to what the transmission mechanism is. Dave?
Yeah, I mean this cash flow effect that is driven by the nature of the mortgage market and the structure. I'd say it's slowed rather than blunted relative. It's going to take time to come through, but as the chart Andrew showed, we think on the stock only about 70 basis points has come through out of a total. If you look at quoted rates on the most popular products, you're up at 300 basis points. So there's a long way to go, but that will build up. This is not, although we've put all these charts in the box today, this is not news to us. We knew that the mortgage market had changed, and we've been factoring it into our forecasts for some time. Overall, I mean, we're continuing to work on this, but overall, we don't think that the overall impact of the transmission mechanism is any less than we think it's broadly the same. And those impacts on demand are coming through. They will come through more market. You'll see that if you look at the summary table and the forecast, it shows that we go from a position of currently excess demand. As slack builds up, we will, and other factors take effect, we will move into an opening up of spare capacity. We do expect some rise, regrettably, in unemployment, but that we think that is necessary. It's a rise now to 4.5%, so less than the more than 5, peak or endpoint in unemployment we had before. So those features are still playing a part, but you're right as well to emphasise the role that the supply side and supply shocks have played throughout this period, in which we consistently talk about, because we think they are relevant to the inflation that we're experiencing and how price setting is developing. But the demand effects from what we're doing and what we have to do in terms of monetary policy, we are still confident are going to come through.
Thanks, John Paul Ford-Rojas from the Daily Mail. Just following up partly on a previous question, you said that Huw Pill's language wasn't the right language. Perhaps you agree that it was insensitive, as some people think. At the same time, the head of the London Stock Exchange is saying that executives need to be paid more to attract them to London, which seems quite starkly different from what you're saying. And you've also said in the monetary policy report that the pass-through of higher rates to savers is unusually weak. So I just wonder whether you think that people in your position, people in the city, people at banks ought to be setting an example. So should Huw Pill, should others in the Bank of England be refusing pay rises?
Well, that's what I've done. Can I just say that's what I've done? So, I mean, just as a matter of fact.
Okay.
Yeah.
Should people in the city stop talking about higher pay for executives, and should banks be doing more to pass through rate hikes to savers?
Well, just to reiterate, certainly, look, I want to speak for myself. I have not taken a pay rise, so that just to emphasise that point. On the level of pay rise for executives, I mean, it's obviously, these things are set by firms, not by us. I've been very clear as a, my past and in my present as a regulator of banks, that we have quite extensive regulation which seeks to create the right incentives for a senior executive remuneration, but it's not about the level. It's about I'm very clear on this point. It's for firms to set that. On your point about deposits, I think, and we go into this quite a bit in the report actually. So it is true that the rate of pass-through to sight deposits has been muted. I think we use that word actually, muted. The rate of pass-through of our interest rate rises to term deposits and fixed rate deposits has actually been much faster and is not very dissimilar to the increases that have gone through into the official rate. Now, I'm not surprised in one sense by that, because let me again put my bank regulator hat on and financial stability hat on, since the global financial crisis, the liquidity regime has been changed so that we greatly incentivize banks holding term deposits. Not got time now, but if you go back to the recent experience of Silicon Valley Bank and so on, you'd probably understand why. I mean, that's a sensible thing to do. Now, what we have seen is, interestingly, but not surprisingly, I think this is sensible, is that there's been some flow out of sight deposits into term deposits, it appears, and that's exactly what you'd expect given the pricing differential. And the point I would make is that I think it's important that people shop around and that we have competition in the banking system. I mean, those pricing mechanisms should take effect in that sense.
Halia Ibrahimi, Channel 4 News. Governor, you talked about the mortgage market changing. But are you worried about those people who are rolling off their fixed-term mortgages? There's millions of them. And for them, the impact of these 12 rate rises is astonishing and very difficult.
Well, let me say again what I've said before, because it's very important that we are very, very aware of the effect that this inflation is having and the consequences of this inflation is having on households. So please do not think that we're not in any sense we are. Now, I think it's important that we obviously are very aware of what these effects are, and as Dave was saying, that we take those into account. That's important. The other thing I would say is, and something we've done, again, I'll draw on the financial stability side of the bank for a moment, that again, for the last, not far off a decade now, we have had policies in place to limit the proportion of mortgages which are at the more sort of the extreme end of the sort of the loan-to-income ratio. Now, that, just to be clear, that was done as a matter of financial stability. It wasn't a social policy intervention, because that's not for us. But I would say that one thing that I think will help is that does obviously limit some of the more extreme impacts that we've had in the past. We've also, again, this is not to do with the Bank of England, we've got much stronger protections in place now for, which mean that there will, people do not have their houses repossessed in the ways that they used to be repossessed. Again, my old crew at the FCA have been very active in that field, and I think that's appropriate. But let me come back to the first point I made. You're right. Of course, these things have serious impacts. We're very sensitive to this, but if we don't tackle inflation, it will be worse for people. That's the bottom line, I'm afraid.
Haga, M&I Market News. Just wanted to ask, given the recent volatility in the projections, can financial markets still rely on the Bank of England's longer-term projections as a reliable communication tool?
Well, we spend a lot of time, we have a lot of staff who spend a lot of time assessing volatility in financial markets to help us to read through that. And you're right, it is interesting. Now, it's interesting in the period before, since the MPC last met, that we've had obviously quite a lot of volatility in financial markets, because obviously we've had some very, very high-profile events going on in world financial system. Curiously, we've done in the UK, it's been a little bit of a round trip, and we've ended up sort of not far off where we started. So that made the MPC's task a bit easier in this case sometimes. But no, look, we have to spend a lot of time interpreting this because of understanding the underlying reasons and the likely sort of follow-through of these things and how persistent they will be. Ben looks like he's...
No, I just wanted to comment on sort of a couple of points about the nature of our forecasts. I mean, first, I don't think they're intended to communicate something, say, about future policy. Historically, they were intended more to explain the current decision. Because of these long lags in policy, We have to make forecasts. Sometimes I wish we didn't, but we have to make forecasts. And we use them to explain the current decision rather than to say, here's what we're going to do for the next 2 or 3 years. The second thing I'll say is from the beginning, this was always viewed as very important and is still very important. They are fan charts. They're probability distributions. They're not point estimates, and they're not point forecasts. And that should be understood. And then the third thing is something we said earlier, is they're conditional. And people on the outside may have different conditions, and that's fine. There are loads of people who make forecasts. I don't think people think, okay, well, I'm going to rely only on the Bank of England who makes a particular kind of forecast. Indeed, a whole range of numbers within the fan. So I'm not sure we view it as a kind of communication device about what will happen in the future.
So the bottom line is this, that the UK inflation problem is not going away quickly. There will be some base effects, of course, and that specifically relates to the way that the energy price cap works in the UK. So in a couple of months' time, it should come down quite considerably. However, there are still underlying forces at work here, and inflation still looks to me to be rather aggressively higher than it should be. And the other point, I think, is that they are now accepting that there will be a high level of unemployment, even if still relatively benign. But the real interesting question for me is the impact of people coming off fixed rate loans onto variable rates that are much, much higher. It's the same problem as in Australia, of course. And over the next few months, that will be another very significant factor to take account of in terms of the economic outcomes in the UK. So, as always, of course, it's interesting that the bank doesn't refer to its quantitative easing and tightening programs, and specifically the fact that that created a lot of the inflation, because nobody wants to admit that that was part of the problem. They keep anchoring it back to supply chain issues and then, quote, second order impacts, and of course, energy. Well, I guess you can always find things to blame. But I'm afraid that the Bank of England is still in the same camp as many other central bankers, where the underlying issues relating to too much money flowing into the system, too low interest rates, were still the root causes of the current problems that they're now trying to tackle. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.